Hello, everyone, and welcome to week 7 of our political economy class. This week, we're going to be talking about taxation in practice. And over the last couple of weeks, we've been talking more about taxation. And it's because taxation plays such an important role in political economy, in the economy, and in that marriage between the public sector and the private sector. So the first chapter we're going to be covering is chapter 22, and as always, we are basing our discussion on these focus questions. So let's get started with focus question 22.1. What are the basic principles underlying the U.S. personal income tax? All right, so if we look at the U.S. income tax, the U.S. income tax is, first of all, it's a progressive tax system. What does that mean? Well, it means that those who make more money pay more taxes, right? And how does the government determine that? Well, it begins with gross income, which is the income that you make before taxes. If you were talking about a business, as far as your individual tax, it's the income that you pay before any deductions. So that's gross income. And then after, of course, you begin to incorporate some of the deductions, and you end up with your adjusted gross income, and then finally your taxable income, which is that income that will determine the tax rate that you are going to be paying at, right? The tax that you owe, essentially. Of course, what happens often is that based on how much you can take advantage of some of the tax loopholes and the exemptions and tax breaks, you eventually arrive at a much lower tax rate than the legal tax rate, the marginal tax rate that you should have paid at. You arrive at what we call the effective tax rate, which is the real tax rate that you're actually paying Uncle Sam. What difference does it make whether taxes are levied on the individual or on the household? And of course, if you're thinking about this question from your personal perspective, it makes all the difference in the world, right? But if you're thinking about this from the perspective of the economy or the perspective of the government, it often doesn't make that much difference. So let's look at this from the perspective of the individual, right? The idea is that those individuals that make more money should pay more taxes, should pay higher taxes, right? This is the progressivity element of taxation. So there's that idea, but then that concept or that premise is often challenged by the family-based principle, which says that if you have a family, so if you're married and you have children, then you should pay based on the family unit, the family-based. If you have if you're filing jointly, you're going to pay a different tax than if you were, say, filing as a single person, right? So, what is the unit of taxation in that respect, right? And are you essentially paying a marriage tax, right? Because those that are married have to pay at a certain tax bracket, because if you were single, you would be paying at a lower tax bracket than if you are married, and filing jointly, you automatically now are paying at a higher tax bracket, right? So we can consider that in some ways as a marriage tax. What are the basic problems in implementing the income tax? And this is one of the big problems with the United States tax system. It's not so much that taxes are necessarily high or low for that respect in some during different times in history. The problem is a problem of implementing the income tax, and that often produces the distortions in the economy that we associate with taxes, the negative distortions, and it also leads to the arguments in favor of raising taxes, which we will see here that sometimes that's not the problem, but rather the implementing the taxes and collecting and making sure that people pay the tax that they're supposed to pay. So what are some of the problems with implementing a tax system? Well, first of all is determining income, right? Because people report their taxes. And so you're taking people's words for it. And even though that the IRS and the U.S. government has ways to determine income, to make sure that people are paying what they should pay, it is far from perfect. And so determining income becomes a big problem. Timing also becomes a problem, right? Because you make income during the entire tax year, and so that will have some deviations that will impact your taxation, and also deductions, personal deductions, right? If you the more children you have, the more deductions you can claim. If you have different property, if you own property, you can have deductions. So does that mean that your income is no longer or should not be taxed based on the amount? And so you can make the argument that it's unfair that those individuals that own property, for example, be able to deduct that or at least a part of it from their taxable income, where other individuals that say don't own a home don't get the benefit from that. So personal deductions often create problems with determining what the right amount of tax should be. What equity and efficiency issues are associated with allowing deductibility of interest, state and local taxes, medical expenses, and child care expenses? Right. So what are the equity and efficiency issues associated with this? Well, it has to do. There is an equity problem here. There's an equity question because it comes down to whether individuals should pay more now versus later. Okay. So, for example, if you are taxing retirement accounts, what you are suggesting is that it's a savings tax in some way. So you are penalizing individuals for saving and enticing and promoting the consumption of income today versus the future. So it is a deterrent to save, which can have negative implications both individually as well as for the economy. There's also an incentive for employers to save for their workers' retirement when you don't tax the future. You don't tax savings, right? And so it creates an incentive for employers to incorporate IRAs or other 401k plans and other types of savings accounts because there is an incentive for them to do that. And it generates welfare gains both for the present as well as for the future. What special provisions pertain to the taxation of income from capital? Okay. So treating capital income, right? the U.S. tax system provides these special treatment or these concessions, lower tax rates, or even postponing taxes to those individuals that have capital, income from capital, or capital gains, right? There are special provisions, for example, relating to housing. Again, if you own a house, that will produce a benefit to the amount of taxable income that can be taxed, right? So owning a property reduces your tax liability. Saving for retirement, pension funds, and capital gains from stocks or other assets. So this preferential treatment distorts the allocation of resources in the economy and often introduces important inequities, which can, when multiplied by millions, can produce some serious allocative distortions in the economy. Okay, Chapter 23, the corporate tax or the corporation income tax. All right, focus question number 23.1. What does the corporation tax actually tax, and who bears the burden? Stockholders, workers, or consumers? Okay, so who bears the burden of that corporate tax, which is often mentioned quite a bit in the news? All right, so the burden of the corporate tax is borne by different members of the economy or different sectors in the economy, depending on timing. For example, in the short run, the corporation bears the burden. Okay, in the short run, the corporation bears the burden because after-tax returns to capital end up being lower. Okay, goods become more expensive. You tax corporations. Corporations often have to increase the price of their goods to continue keeping those same profit margins. Okay, and so something that would be similar to an increase in the cost of production for a production firm, even, for example, the cost of labor, right, or any cost of production, increases the cost of production, thus increases the price that firms are going to sell their products. So that creates a problem, because as goods become more expensive, the quantity demanded for these goods tends to drop, and therefore sales drop, and often leads to potentially higher rates of unemployment, which means even potential deductions in the collection of fiscal revenue from the government, right? So these are some of the burdens that are produced in the short run. In the long run, the burden is borne by all of the actors in the economy, right? So producers will suffer. The producers will eventually have to increase their profits or lower their cost of production, which often means that they have to fire workers. So people will become unemployed, less demand for goods and services. And so all of this means lower productivity, lower output, higher unemployment, and so the burden is borne by all the actors in the economy. How does the corporation tax affect economic efficiency? Well, similar to what we just explained, okay, but perhaps a little bit more specific. The user cost of capital, right? The tax system affects how much it costs a firm to use capital. And so remember that capital is used in production of goods and services, right? And so the cost of capital will be impacted. For example, with accelerated depreciation and full deductibility of interest payments, investment may actually be encouraged relative to a no-tax situation, okay? Investment is discouraged in assets which are financed by equity, and those in which the benefits of accelerated depreciation are limited. Short-lived assets that depreciate, like property, plant, and equipment, or a truck, for example. The user cost of capital in general is affected, which affects productive efficiency for firms. Okay, focus question 23.3. How does the corporation of tax affect financial decisions? And these are how a corporation will finance its operations, either through debt or through raising paid-in capital, whether it's going to pay dividends to its stockholders, or even in what kind of decisions it will have as far as mergers, for example, or acquisitions, right? So what are some of the impacts on financial decisions? Well, if you look at, for example, debt to equity ratio, this is going to be one area where taxation will impact the financial decisions of a firm. How much debt will the firm decide to absorb or to get into based on or relative to equity? Okay, do you leverage more, right? Do you borrow more to finance your operations? And do you decide to borrow, or do you decide to raise capital through, for example, issuance of stock, right? So financial decisions are going to be affected based on the capital structure that is taxing some of these activities. You also, again, consider accelerated depreciation and cost of capital to whether you decide to invest in these fast depreciating assets or not. Okay, and corporate tax also. Remember that corporate tax is also a tax on affects those firms more, which are credit constrained firms. Okay, so these firms that cannot raise capital as easily as the large firms, right? Firms that are smaller, that don't have millions of dollars to raise from stock, right? From paid-in capital. These firms that can't borrow from banks as easily, a corporate tax will affect these firms much more than the other firms that do have these options. Should there then be a tax on corporations? If we think about one of the biggest corporations in the world today, Amazon, right? Think about whether the government should tax Amazon or not. And of course, there's this whole argument and, in fact, uproar about Amazon not paying income taxes, right? And that's an argument, and that's a story that merits revisiting, and in terms of equity and efficiency and accountability. Should perhaps the government ought to take a closer look at corporations like Amazon, right? And to see what exactly is happening, and whether they should pay a special tax, right? But it depends on the corporation and the market structure. For example, those firms like Amazon, if Amazon essentially is a monopoly or enjoys monopoly power in the economy, then perhaps they ought to be taxed. And not necessarily because of a philosophical argument against Amazon making profit, but rather to reduce the negative distortions that monopoly power creates in the economy, right? You want to reduce these distortionary effects as much as possible. Ultimately, though, who will be impacted, right? And so if you tax a firm like Amazon, does Amazon transfer that tax burden onto the consumer? And if Amazon were to compete for consumers, then Amazon could, or in fact, Amazon would have to absorb that tax. But because Amazon maybe doesn't have a direct competitor that can compete with it, then Amazon can transfer the entire burden to the consumer, because the consumer simply has to use Amazon if it wants to enjoy that benefit that Amazon provides. So more competitive market scenarios, more competitive market structures tend to transfer the burden to the corporation, because the corporation has to absorb the tax. Less competitive market structures often lead to the tax burden transferred to the end user, which is the consumer. Okay, Chapter 24. A Student's Guide to Tax Avoidance. Question 24.1. What are the two major principles of tax avoidance? Okay, so what is tax avoidance, first of all? And tax avoidance, we said, was the idea that, or the concept that tells us that individuals and firms will avoid paying taxes because they will avoid paying taxes when taxes are high. So there's this whole argument that the more you increase taxes, the greater your tax avoidance will be. And tax avoidance can be legal and it can be illegal, right? You can have use and take advantage of the tax loopholes and the benefits that are provided. You know, these accounting tricks, right? You can postpone taxes, right? You can shift the taxes, right? Shifting and tax arbitrage, okay? You can do many things, right, to avoid paying taxes. So the principles of tax avoidance have to do with postponement, and tax arbitrage. And postponement means, well, you simply postpone paying the tax until the future. Whereas tax arbitrage means that you can actually tax people, put people in different tax brackets and based on their income. And that allows you to avoid certain taxes, right? As long as you keep within a certain tax bracket. How do tax shelters work? And who gains and who loses from their distortionary effects? So who gains and who loses from tax shelters? All right, well, short-run beneficiaries, right? Who are the short-run beneficiaries? Owners of factors which are specific to industry at time preferential treatment is introduced or announced, okay? Those who market tax shelters, these are the short-run beneficiaries. In the long run, most of the time, the beneficiaries are the consumers, okay? So the short-run beneficiaries of tax shelters are producers, owners of factors of production. In the long run, it's the consumer, right? Through lower prices as the industry expands, right? More competition, more choices, more producers. So the consumer ends up benefiting from these tax shelters. Who are the losers from tax shelters? Well, the losers are the taxpayers, right? And why are the losers the taxpayers? Well, because as you have these tax shelters, while tax shelters produce these desirable positive externalities from being able to reduce the tax burden, at least in the short run, reduce the tax liability or transfer that tax burden and that tax liability and use those funds or those monies, those savings, into other more productive uses or more desirable uses, eventually, if these tax shelters become too great in the economy, then you end up with, you could end up with lower fiscal tax revenue, and that could have a negative impact on everybody's taxes, right? Because at some point, too much tax shelter will reduce the tax revenue, and some of the necessities that are being financed with this tax revenue might suffer, right? The economy could also suffer from a misallocation of resources, right? Perhaps there is money being placed into these tax shelters, these IRAs or 401s or what have you, where perhaps there's too much money put into these and not enough money put into other places where the economy could also benefit from. In what ways have recent tax reforms affected the opportunities for tax avoidance? Well, tax reform has been around for a while, right? We have, over the last 40 years, right, some of the major tax reform that continues to affect us today. For example, Tax Reform Act of 1986. This major piece of legislation restricted tax loopholes by dividing income into categories. So it allowed us to separate how you could determine your income. Okay, 1993 to 97 tax acts. These introduced more opportunities for tax avoidance, provided tax shelters, okay, and increased the top marginal tax rate. In 2001 to 2003, under the George W. Bush administration, these tax acts produced some positive results, but also negative results, and so the result from these is ambiguous. And the American Taxpayer Relief Act of 2012, under the Obama administration, indexed income thresholds to inflation. Okay, Chapter 25, Reform of the Tax System, since we're talking about reform here. So let's look at some of these key issues related to reform. Okay, what have been the major impetuses for tax reforms during the past 3 decades? Well, very simple. The impetuses for tax reform has all to do with increasing the fairness of the tax system, right? We have a progressive tax system, but the tax system seems to favor those individuals who are best able to use the system for their advantage, right? So those that are best able to reduce their marginal tax rates through tax deductions, right, and tax avoidance, right, so that you end up with a lower effective tax rate. So increasing the fairness, right? Those that are making more money and benefiting more from certain things should be the ones to pay more, right? So a progressive tax system. So increased fairness, but also improved efficiency, right? So improve efficiency not only in the way that we collect taxes, right, but also in how we use taxes. So do we need to spend millions or even billions of dollars in the IRS fiscal tax system? Would there be a better way for us to use this revenue and distribute it and invest it and spend it in ways that are much more efficient, right? So improve the efficiency of the whole system, both in the collection, in the observance, right, and making sure that people pay their taxes, but also in how we use the tax revenue, right? And then this also leads to reduced complexity of the tax code, which is one part of the reform that seems to always escape politicians and tax accountants and tax experts. This the seeking to reduce the inefficiency of such a complicated tax code, which would reduce administrative and compliance costs associated with taxation. How successful was the 1986 Tax Reform Act under President Reagan in lowering marginal tax rates, providing a level investment playing field, closing some of the loopholes that the tax code provides, and simplifying the tax code? Well, it depends on who you ask, right? Because if you ask certain individuals, especially leaning right, they might argue and make very positive arguments about the 1986 tax reform. On the other hand, if you ask some other individuals that might be leaning a little bit more to the left, and they will have a very negative perception and evaluation of the tax reform. But the tax reform sought to broaden the tax base, and while it may have had that intention, in some cases perhaps it did, and in some others it did not. It also failed to simplify the tax code, which was one of the main objectives from this tax reform was to simplify the code. And while corporate income taxes were increased, it's debatable on whether this had a positive impact in fiscal revenue, because what it essentially did was it increased the incentive for corporations to avoid paying taxes. How did tax changes from 1981 to 2012 alter the degree of progressivity of the tax code? So in 1993, the tax bill increased marginal tax rates on high-income individuals. Again, you increase the marginal tax rates on high-income individuals, you assume that the tax fiscal revenue will increase, but what you end up with is a Laffer curve effect, where as you increase the marginal tax rates, you also increase tax avoidance and the propensity for those individuals to use tax shelters, to hire very skilled and qualified accountants to find all the different loopholes where you can reduce your marginal tax rate and come out with a very low effective tax rate. The 1997, 2001, 2003 reforms reduced progressivity through preferential treatment of capital gains. So this was kind of going backwards, right? And instead of promoting progressivity, some of these reforms actually, or at least some economists argue that they reduced progressivity because they provided all of these preferential treatment for those individuals who benefited from these capital gains. Of course, this favored the rich and not those at the bottom of the economic strata. And then 2003, the 2003 bill lowered tax on dividends, which created an even more reduction in progressivity, right? What are some of the basic trade-offs in the design of tax reform? Well, what are some of the trade-offs related to taxes? Well, taxes, it's all about present versus the future, right? If you increase taxes on income for welfare or for Social Security, if the point of increasing the taxes is to increase the provide for Social Security pensions, then you're essentially creating or making a decision about the future. You're valuing the future more than you are the present. You are creating a system of those that are working now are providing for those who were working before, right? And so it's all about a trade-off between the present versus the future. It's also a trade-off between consumption and savings and investment. So consumption versus savings and investment. Do you promote consumption today versus tomorrow? If you increase sales taxes, for example, you are creating a disincentive to consume today, and hence an incentive to save. Right? You tax income in the future, or which is savings. Then you are creating a propensity to consume and save less. If you reduce the taxes on savings and investments, then you are creating an incentive to invest for the future, right? So, for example, invest in a home or invest in a retirement account that will provide you the necessary income for you to be able to consume in the next period. There's also a trade-off between tax avoidance and tax revenue, right? You want this is the Laffer curve effect. You increase taxes because you need more tax revenue, but by doing that, you're also increasing the propensity for individuals and firms to avoid paying taxes more. So there's that trade-off. Then firms also make decisions based on taxes, right? So do you tax or do you borrow? And the government is no different. The government can, if it needs money to pay some of its things, right, and to provide the things that it needs to provide for the people, it can either increase taxes or it can simply borrow more money from us, from taxpayers, and essentially it's borrowing from future generations too, right? So either you tax the current generation today, or you decide not to tax, which, by the way, is not the politically desirable alternative. It's more politically desirable to borrow from future generations who don't have a say in the politics of the day, right? So do you tax or do you borrow? And then, of course, the trade-off in what you tax and how that's going to have an impact on other sectors of the economy. So do you, for example, increase the taxes on pollution and environmental degradation, like a coal tax or pollution tax, and how is that going to affect economic expansion? So that's important for you to consider. What are likely to be the major directions of tax reform in the coming decades? So where do we go from now, and what are taxes going to look like from here on out into the 21st century, right? As we head into the 2021. There's conflicting objectives, right? Because as the economy and as the society gets more complex and diverse in conflicting and competing objectives, where we tax and what we tax and who we tax become arguments for politicians and for economists. The Progressivity versus lowering marginal tax rates will continue to be a debate. And of course, the major reforms proposed, for example, value-added taxes. Do we change the way that we tax in the U.S.? Do we incorporate and implement more value-added taxes? Do we begin to tax sources of energy production, like energy taxes? Do we implement a flat tax, and what kind of a burden will that produce? Or even consumption taxes, right? Or financial taxes. So the 21st century, like the 20th century, we will continue to have similar challenges to taxation. Okay, so in summary, I guess when we think about taxes, we have to think about taxes as a necessary evil, and taxes are essential for income distribution in the economy. Progressivity is the name of the game. The U.S. tax system is a progressive tax system, and sure, those individuals that make more money should pay more taxes. I think that's an argument that is plausible, at least. But the problem with that is that it doesn't necessarily happen that way, because, as we have seen, the higher you get into the higher brackets and income brackets, the better your ability to avoid paying taxes, to seek these shelters, to take advantage of all of these tax loopholes and deductions, right, which don't end up raising all boats, so to speak, right? Those at the bottom don't have these options, and so the tax becomes a greater burden to those at the bottom instead of those at the top, and so you don't necessarily raise all boats evenly. Of course, you want to promote economic growth and efficiency, right? But this often it doesn't go hand in hand, right? As you increase taxes, you are making the cost of production or the cost of labor, for example, if you increase taxes on individuals, on income taxes, individuals are going to require higher wages to continue working, and so this is a detriment to economic growth. And so you have to take that into consideration, and also the efficiency of the economy, right? We know that any tax produces a burden, an excess burden, right? Whether it's on the consumer or the producer. And so, in terms of economic efficiency and allocative efficiency, you have to take into consideration how much to tax and who to tax and where to tax. Because the ultimate goal is, of course, to minimize that tax burden as much as possible. All right, so that is the lecture for this week. I hope you enjoyed it. As always, if you have any questions, please feel free to send me an email, and I'd be more than happy to provide you with guidance and answers. And as always, take care and God bless. Thank you very much.